Hello, everyone, and welcome to the LBMA Annual Precious Metals Forecast Survey. Joining us today on the panel are Nicky Shiels, Head of Metal Strategy from MKS PAMP, Ross Norman, CEO of Metals Daily, James Steele, Chief Precious Metals Analyst from HSBC, and Jonathan Butler, Head of Business Development from Mitsubishi Corporation. Now, before we begin the webinar, I just want to draw your attention to the Q&A button at the bottom of the screen. If we can move on to the next slide, please. So if you have any questions during the webinar, if you click on the Q&A button and you can submit your questions that way, we will come to those as we reach the end of the webinar. Now, without further ado, I will hand over to Nicky to begin. Thank you.
Thanks, Tamsin. Great. Thanks, everyone, for being here, and obviously to Jim, Ross, and John, and to everyone, wherever you may be. So the idea of this webinar series is just to dissect all the analysts' forecasts that we submitted to the LBMA for this year. So the slide I have up here I thought was pretty relevant. We trying to just assess how accurate all of our forecasts are, the average of all analyst forecasts, going back the last 14 years. And I'll go through them quickly, and then we'll dive into a discussion around each of the metals. So for gold, the average forecast for this year is 2059. The takeaway here is every LBMA analyst expects new all-time highs, which is pretty consensus. And it is, I would say it's a mildly bullish outlook. Historically speaking, analyst forecasts have been too bullish 8 out of 14 years. On silver, the average analyst forecast has been too bullish 9 out of 14 years, so a little more skewed on that side. And the price average for this year should be 24.80, which is quite above current levels. So we'll dissect some of the price underperformance in silver going forward. And then on platinum and palladium, obviously both assets are sub 1,000 at the moment. Interestingly, most analysts expect palladium to retain a premium to platinum going forward into this year. The average forecast of 10.85 for palladium and 10.15 for platinum. So without further ado, we can dive into the discussion. Great. So Ross, I think I'll start with you, seeing as though you're the one with the most bullish LBMA forecast. I think you have 2166. So perhaps maybe walk us through some of your drivers, what you see going forward into this year, for why you have a relatively high gold forecast versus the street.
Sure, thanks, Nicky. Actually, before I start, by the way, can I also just say thank you to MKS for sponsoring this thing that you put on. You really did the sponsors get a full mention, and so thank you, Nicky, for you and your team for that. When we did the forecast, I didn't actually think I was particularly bullish, and I was a bit surprised to see I was second highest in the league table in terms of where we thought gold would end up this year. My forecast at 2166 is actually only 4.5% above the first fix of the year at 2075, and the expectation is that gold will hit a 2300 level as a high during this year, which is just under 11% over the course of the year. 11%, and just to remind you, the run rate for the gold price over the last 50 years is around 8% a year compounded. So our expectations are a warm year for gold, but not an outrageously hot one. The key drivers, as we see it, are in 4 areas. Central banks up front. After 2 stellar years in which gold saw 1,082 tons and 1,037 tons in the last consecutive years, and just to remind you, that's running at roughly double the average of the prior decade at 511 tons. So it's been a very hot year for the official sector buying. And of course, the rationale for doing so are the usual diversification and the long-term the purchasing power parity that gold has. But more importantly, I think, is the risk element. As over the last generation or 20 years, the number of trade sanctions put in place around the world have gone up 4-fold. And sanctions are seen as a foreign policy tool, especially by Western nations. Weaponization, if you like, of the dollar and access to the dollar payment systems. And central banks around the world, not just those from the BRICS nations, non-aligned ones, I think, are asking, well, could we be next? And I think there's a degree of caution there. And ultimately, gold is no one else has promised to pay, and gold has benefited from that. So clearly, we see that trend continuing. And amongst those buying nations, you've got Singapore, the Philippines, Czech Republic, Ireland, Poland. Gives you an idea of the sort of nations that are bolstering their reserves at this time. The second area is Asia. And up front, let's start with China. Last year, it had a very significant 910 tons of demand. In January this year, this last month, I should say, wholesale demand was a record 271 tons, up 65% month on month. Yes, I know it's the Chinese New Year. Yes, I know it's the Year of the Dragon, both very auspicious periods of time for buying. But what's unusual about the Chinese demand is that gold's near an all-time high. It was up 17% last year in yuan terms, and indeed premiums are running at 45% direction, $45 over the international price. So what's shocking really is that we normally look to Asia as being price elastic. If it's cheap, they'll buy it. And if it's expensive, they will pull their orders. But the Chinese are buying into price strength, which is unusual, price inelastic. Now, what distinguishes those first two sectors, central banks and China, firstly is they're opaque. Central banks no longer give you a heads up in advance of a buying program, much like the Bank of England did back in the late 1990s, or indeed the Washington Accord. You hear about it after the event, so we don't see that stuff. And also the Chinese market is relatively opaque as well. We just, we don't have quite the visibility that we have of other markets. And I think that might provide a little bit of bias in terms of people's readings of the markets. And it's those two sectors which we think will be preeminent. In China, of course, you've got the Chinese share index down, well, losses amounting to $6 trillion over the last 3 years, and $4 trillion of unrealized real estate losses as well. India, well, the fastest running major economy at the moment at 8.7%, roughly the rate of China. Again, Indian prices running at a premium, a modest one, albeit $3.50 on a spot basis over the international price, a 4-month high. So again, we're seeing a degree of price inelasticity in India. And we think that with a strong Indian economy, that will be supporting China for buying. In the two remaining areas, you can't not mention, if you like, the end of the Fed hiking cycle. In 2008, 2006, and 2018, this triggered that is to say, the end of the hiking cycle, triggered rises in gold of 57%, 235%, and 69%, respectively. If you look over the longer term, over 40 years, we've had 7 rate hikes, and gold has averaged a 15% increase in the first 200 days. And that's what we're looking at, where our expectations are. Finally, from my side, it's 2024 marks the year of the elections, with close to half the planet's population going to the polls. Cynic that I am, incumbents might be tempted to get their central banks to release the handbrake on the economy. In other words, lower rates for that feel-good factor, with a possible hope of having another period in power. So I think there'll be some pressure on central banks to ease up a little and get some wind behind the economy. In short, we think the tailwinds will outbid the headwinds, and gold set for another all-time high during the course of this year.
Okay, great. Thank you. That was super comprehensive. And, you bring up two good points in terms of these support pillars for gold. It's central banks and it's physical. And it's been, those have been the two major drivers and pillars for the last 2 years, which have basically more than offset what we've seen in investor outflows, which is basically sort of very macro driven. And so sort of want to switch to Jim and John. Both of you have averaged relatively bearish, but not really, just average forecast below 2000. So how do you see the threat of real rates, potentially a higher for longer Fed, or stronger US economic data playing out with investor outflows? Because that really is the offsetting factor to some of these major physical and central bank purchases over the last 2 years.
Well, yes, that's right. And but before I start, Nikki, I'd like to echo Ross's thank you for the sponsor, and also to the LBMA for their gracious invitation to talk on on gold and the other precious metals today. When I put my forecast in, I didn't regard it as bearish, and it's very hard for me to think about gold not much below $2,000 as a particularly bearish forecast. I think we should all note that gold is already very, very high, and that in the past we have seen some demand destruction, and I think that's one of the key things. But I would certainly cede a lot of ground to Ross as far as central bank demand goes, and some of the other issues. Now, when we strip out, or when we do our best to strip out where the dollar is, where it might go, jewelry demand, mine supply, et cetera, gold appears to be, particularly when you look at real rates, as you've pointed out, several $100s above where it should be. And I do think that is attributed to geopolitical risk. And the problem with geopolitical risk is this audience, I'm sure, and certainly all of us, are number oriented, and you can't model geopolitical risk. That's the problem, because every geopolitical event is different from another. It's not like saying what happens when the Fed hikes rates 25 basis points and then another 25. But we will have the bulk of the elections over by May, with the US one being the major one. So I wonder if we might see just some relaxation. But I would argue that geopolitical risks are unusually high. And I think it's the frequency of events. If you look at 10, 15, 20 years ago, the number of geopolitical events, according to the World Bank and the IMF, were high enough. But in the last 3 years, they're double what they were in the previous 15 years. And so this argues for high prices. And I would regard my forecast, even though it's below where we are now, as still relatively strong. The central bank demand certainly also dovetails into the geopolitical risk element, because I do think that's a large component of why certainly some central banks are purchasing gold. Now, we have to watch here, because if we take a downturn in trade or a slowdown, and we get a reduction in dollar holdings in some central banks, this may deter them from buying, from adding to their official sector reserves. We do note some correlation between surplus dollar reserves, if you like, or what they would regard as surplus, what their managers regard as surplus, and what they would buy. So I do think central bank buying will remain very strong this year, certainly historically strong. I don't know if it'll be at 2022 levels, however. Now, on the real rates argument, we certainly had this cleavage beginning in 2022, didn't we, where rates went positive again and the gold market remained high. And a lot of that was geopolitical risk and central bank demand. I wonder if over time we won't begin, I'm not saying that the gold market will go back to being lockstep with real rates by any means, but I wonder if it's not going to begin to have more of a negative influence on the market. And I think it's not so much if the Fed cuts this year, but by how much they cut and when they cut. Now, up until fairly recently, the Fed futures were giving us 158 basis points of cuts this year. HSBC, we have stuck to 75 basis points of cuts this year. And the point I want to make is that if the gold market has rallied on expectations of 150 basis points of cuts, even though that might not be the figure that Fed futures are looking at today, and we only get 75 by the end of the year, the gold market may have to recalibrate a bit lower. Not much, but a bit. Now, look back at what happened last year. If you remember January, February, March, we were supposed to be headed, the US was supposed to be headed into a recession. The Fed was going to cut in the summer. The gold market rallied. And then the gold market was goosed further by the budget standoff and bank stress, a few other things. When it became apparent that we were not headed into recession, the Fed was not going to cut, the gold market began to drop from June right through to October, right to the eve of the Hamas attack. And we may see that again. And I would just finish off, because I don't want to take up too much time, is that a 10-gram bar in India is over 65,000, I think around 65,000 rupees right now. I realize the physical market hasn't reacted yet. I do believe that they will. I do believe that these high prices will eventually wear on demand, not only in jewelry, but also in bars and coins. And that, which appears to be the case with coins at the moment. So I wouldn't regard myself as particularly bearish, but I think according to the LBMA survey, I am cautious. Not usually a word associated with me, but I am rather cautious about the market up here, just a wee bit.
Great. And John, do you have anything to add in terms of being relatively cautious, or what sort of keeps you up at night with your gold forecast?
Yes, thank you, Nicky. And just to echo Ross and James, also to say thank you to MKS for sponsoring this competition once again, and also to the LBMA for providing this forum, including the webinar today. So a little bit like Jim, I don't consider myself to be particularly bearish. My forecast for this year is 1975, which is a little lower than where we are today, but not much lower. And for the very same reasons, I believe that the gold price is going to stay reasonably elevated, probably in a range of 1,800 to 2,200, thus allowing for some all-time highs throughout the year. And of course, that's driven by the lower yield environment, times of weaker dollar, as we've seen recently, and also, most importantly, the US Federal Reserve expecting to dial back interest rates by about 0.75% throughout this year. Now, the risk, the thing that keeps me up at night, I guess, is that in response to that, the market has got a little bit ahead of itself. As Jim said, they were forecasting maybe 150 bips rate cuts for this year, which is very much out of sync with what the Fed have been telling us, including in the last the dot plot from December, and also some of the comments from the voting members over the last few weeks. And that is they're going to stick to their guns on 0.75% in the light of consistently high inflation, above target inflation, and also some of the political risks that have been mentioned, including potentially more inflation coming down the road from some of the activities going on in the Middle East right now. So if the pace and magnitude of rate cuts ends up undershooting the market expectation, then I think that's when gold could be in for a down correction. Having priced in this relatively favorable yield environment, if it turns out that rates stay higher for longer, as we believe it will, then that's where gold could fall into a bit of a bear trap. Notwithstanding some of the other points that Ross has made, the geopolitical tensions, the US elections, and of course, ongoing purchases by central banks, I think there is a risk from here as expectations get a little bit ahead of where rates will actually go. Ross, I think you wanted to...
Yeah. Sorry, Nicky, if I could just jump in there. Nicky, could we have the benefit also of your thoughts? You're an analyst.
I was going to say what keeps me up at night is certainly this higher for longer, which may morph into, like I said, Bloomberg had a headline today. What if we start talking about Fed hikes, not cuts? If you get US exceptionalism, that story continues and data continues to be to the upside. It's not our base case. It's not the market's base case. The Fed still expects three cuts this year, and the market has dialed back Fed cut expectations. But I worry because it really is all about the Fed, and that will accelerate ETF outflows, investor outflows. Yes, you will have physical and central bank demand sort of scoop that up, but I think any sort of higher for longer / incremental rate hikes is a big a bearish threat to my forecast, which is 2050, which I would say is pretty neutral relative to the group. Okay, so on that note, let's switch gears a little bit and talk about silver, because gold is a $2,000 asset. It's holding in pretty well. We're talking about range bound to slightly higher pricing. Yet, if I think you look at a 10-year chart, if gold is above 2,000, you think silver should be $25 and above. And we all have forecasts pretty much around 2450. Silver is significantly underperforming both the average analyst forecast. It's significantly underperforming the fact that you've had record high PV capacity build out in China. You've got record high industrial demand last year, another one expected this year. You've got stock flows, whether it's CME, the LBMA drawing down pretty dramatically. You've got premiums. There is a very attractive fundamental story to silver as both an investment and a sort of green energy transition metal. Yet, is it going to fall into the same trap as platinum and be this deficit metal that keeps going down in price? So, John, what are you seeing on the ground there? How do you sort of square this deficit story in silver with price action, and is it just all about above ground stocks?
Yeah, thanks, Nikki. And just to pick up on your point there about the green energy transition, I think that's a real positive for silver demand in 2024 and beyond. And specifically, there's two main applications where that comes in. There's the use of silver in solar photovoltaics, which has been growing extremely strongly, high single-digit percentage increases in solar PV installations. That's good, not just for the silver that goes into the solar panels themselves, but it's also about the interconnects, the grid infrastructure that also uses quite a bit of high-grade silver. So in the solar PV sector alone, in 2023, we saw about 160 million ounces, which is about 15% of total demand. And we expect that's going to increase incrementally over the next few years, reaching 25% of total demand by the end of the decade. Now, there's a lot of assumptions in that. There's obviously a lot of green funding going on right now. We see it in the Inflation Reduction Act in the US. We see it in Europe in the Green New Deal. There is, of course, some argument to say that some of that may dry up, particularly if the US administration were to change and there was a rebalancing of some of that inflation reduction funding towards more conventional, less green technologies. And that's certainly something that candidate Trump has mentioned in the past. Even in some of the more developed markets where solar PV has long had a history of uptake, such as in Germany, there's also been some questions about how far this build out will be underpinned by ongoing government subsidies. So that's something of a risk to that forecast. But generally speaking, solar PV globally is still a positive demand factor for silver. The second thing is vehicle electrification. We hear a lot about that. And of course, it's generally quite negative for platinum group metals, which we'll come on to in a minute. But again, there's two elements to this. There's the use of silver in the vehicles themselves. Again, it's usually in the battery interconnects. Typically, the amount of silver used in a battery electric vehicle is something like 3 times the amount used in a conventional internal combustion engine vehicle. And that equates on average to about 1 ounce per vehicle. Now, that doesn't sound like an awful lot, but if you scale that up to 90 million light-duty passenger vehicles, you've suddenly got a big number. You've got close to 10% of annual demand. We're not going to get there right away, but the direction of travel is pretty clear. Greater numbers of electrified vehicles, both hybrids and ultimately battery electric vehicles, and also that argument that the grid infrastructure has to be built out in parallel, and that's going to require more high-grade silver in some of those large voltage interconnects. So those are the two kind of green economy factors. There's a couple of other factors that are helping industrial demand for silver right now. One is conventional electronics, if you like, not necessarily part of the green economy story, but the build out of 5G enabled mobile phones and the silver conductive materials that are contained within those. 5G enabled handsets are something like 65% of the global market right now, and the 5G handsets have more chips, more resistors, more electronics within them, and therefore those loadings, tiny though they are per unit, are extremely high, and we've got close to 1 billion units a year being sold. And also other applications like VR headsets, specialty electronics, and safety systems. Those all involve some silver usage. And even the the relatively mundane ethylene oxide industry, part of the petrochemical industry. It's another big user of silver, and it's undergoing something of an expansion right now, driven by low energy prices, particularly in the United States due to the shale gas revolution. So there's structural trends that are upping the loadings of silver in things like battery vehicles and in PV. But all of this is dependent on continuing economic growth. And that's one of the risks that I know the panel have identified here in 2024, the slowdown in China, the slowdown in the US, and generally that cyclical change that we may be beginning to see. So that's the caveat on that. But generally speaking, the structural trends are still quite positive towards greater silver demand.
Yeah, no, you point out, I mean, it really has an attractive sort of more medium to long-term story in terms of the structural demand drivers. It just, you've got the recession overhang, a China overhang, a destocking overhang from perhaps above ground stocks. And then, from our side, there certainly has also been just very lackluster investment demand. And, the US retail consumer is sort of sitting on the sidelines in terms of buying coin and bar demand. But again, it's an election year. Things can change very quickly, and we can see that cohort re-engage very quickly.
Right, absolutely. You mentioned earlier, Nikki, the above ground stock, and I think that's really the answer to why we see these sustained market deficits in silver, and yet price action is fairly unexceptional right now. Right. We also see the forward market in a fairly rich contango, indicating there's no real supply issues here. Because there is that stock of material, many years worth of e-waste, plus there's metal in ETFs, there's metal in holdings on the exchanges, in the hands of private investors. All of that can come back to the market at a price and generally keep the market adequately supplied. So when we talk about an on-paper deficit, as we do in silver right now, it's not really underpinning any sort of price rally. And certainly from Mitsubishi's point of view, we don't see that happening unless we go towards sort of $30 and we start to see the mobilization of some of those stocks coming back.
Right. I mean, it's certainly a common thread with with platinum, where it's the market as a whole has been generally overly bullish for 11 out of 14 years, and sort of the above ground stock story has really just managed to supply those deficits and keep prices really contained. And maybe we switch quickly to platinum, but from your point of view, it's what are you seeing from the demand side, and is it all about just the expectation or the actual production cuts that we may see from producers that will get platinum sort of sustainably above 1,000 this year?
Yeah, absolutely. I mean, for me, platinum, I'm forecasting 1050 as the average, and that belies quite a large trading range, maybe 850 up to 1200. And very much a story on the supply side. We've already heard about the production cuts at Anglo. Sibanye have also announced around 60,000 ounces of production cuts. Not very large in the overall scheme of things, but definitely an indication of the direction of travel that things are going in with these sustained low prices, and the fact that a large portion of the South African mining industry is underwater at current levels. On top of that, of course, we've got the potential for disruption to mined output in the form of operational labor, electricity supply shortages. Those issues have not gone away. They weren't really the dog that barked in 2023, but there's always that potential again in an election year that things can escalate quite quickly. So the supply side certainly should underpin somewhat higher prices than what we see right now. But of course, at the same time, the demand side isn't looking all that great. We've got limited growth in car sales, threat of recession, and I'd say the incentive to substitute palladium with platinum, if we do see that sustained parity, or indeed platinum go into a surplus against palladium, I don't think that's necessarily going to change things on the technical side. Of course, many automakers are very much focused on the electrification and not on re-engineering auto catalysts to reflect relative changes in the valuation of platinum and palladium. So overall, I wouldn't say I'm too bullish on platinum, but there is that potential that supply disruption could drive things higher.
Right. Yeah, there's certainly the threat to the upside, given both metals are sub 1,000, and that market balance can tighten very quickly with any large supply cuts. the other way, or the sort of the complementary way of how balances can sort of tighten up is through investment demand. And in palladium, investments has been running pretty net short or gross short, but in platinum that can swing. Do we see what does the panel think about platinum investment demand? And will that be the sort of swing play or swing factor for pricing in 2024?
I think we may very well see some additional demand coming into the platinum market from the investment side. I know we've been sort of expecting it, and for a long time when gold had reached extended its premium over platinum, there was a lot of talk, similar to the gold-silver ratio, that we would get some movement back into the platinum market. I think the platinum is only about 6% the size of the gold market, and all of the gold in the world, I think, is less than 2% the value of all the financial markets. So you don't need a great deal of buying to come in to really motivate things. But in addition to, I think, the potential there, and I know it's been a long time waiting, you would have lost money had you bet on platinum rallying against the gold market. I think there comes a point where it can't go much wider, and you're likely to get some sort of demand in platinum vis-a-vis the higher gold price and second derivative players coming in. But we may also see that stimulated through if the non-automobile demand for platinum continues to increase the way it is. You know, it really has been quite strong, and there's a whole range of things that, frankly, John is very erudite on, but even as a scientific layman in the extreme, I can still recognize as being potentially quite positive for the platinum market going forward. I mean, just to say quickly on the palladium, those shorts have got to cover eventually. Now, one might have gone bankrupt waiting for it, but it isn't like waiting for Godot. It will materialize, and higher rates or rates that stay fairly firm could begin to trigger that. As soon as that group stops making money being short palladium, we could see some real short covering.
Ross, you were sort of notoriously probably one of the most bearish palladium forecasters out there, and you did notice sort of recognize the threat of a short covering rally. So how do you look at that market where, yes, you've got fundamentals softening on one hand, but again, just the extremity in positioning and sentiment, and maybe walk us through your thoughts on palladium, please.
Yeah, when you publish your forecast, it's quite funny. You look to see where you sit on the league table, and I was shocked to see how bearish I was compared to the consensus. It's surprising to think that only a couple of years ago, palladium was trading up at just under $3,500, but here we are at sub $1,000. Yeah, our average for the year is a rather dismal $724 an ounce. I suppose our thinking really is you know, the market swung from a 200,000 ounce or thereabouts deficit to a 300,000 ounce surplus. There are large above ground stocks. Substitution for palladium from platinum is continuing. It's in a sector which is in decline. I take your point, all of you, that there is a significant short in the market, and indeed we've seen some short covering rallies, which the only positive thing I could say about palladium was, well, it's vulnerable to short covering rallies, and we could see bounces, but they will provide temporary relief, perhaps only. Mm-hmm. But at its heart, palladium is what, 90% of it is a byproduct of something else, and nickel primarily. And to understand palladium, I think you need to understand nickel. And the battery market. I don't think the producers will scale back nickel production, palladium production, on the basis of its price. But I think they'll be rather more concerned about where nickel's going. And of course, at the moment, nickel's quite cheap. So I think it's the host metal that one has to look at. And at the moment, I think that palladium is being produced as a desire to extract more nickel. And I think that also will add to some downside pressure on the palladium price. So we remain a bit of a bear here. And, you know, in trading terms, there's an expression that the trend is your friend. And I think that applies to the direction of some of these metals as well. The palladium seems to be under the cosh somewhat. I just don't see it ending for some period to come.
No, I absolutely understood, especially in the context of a soft macro and China environment. It's tough to get super bullish, but at the same time, yes, those short covering rallies can certainly provide some opportunity to reshort for those who've missed that move. Right, so I think we have a few questions. But if you're happy, we can jump to the speed round and just sort of wrap things up with what we spoke about. I think giving context to our precious metals market is super important, and we touched on this through the various products. But overall, in your mind, is commodities broadly as an asset class, not just precious metals? Are we in a bull market, a neutral market, or a bear market?
Going around the table, I mean, I'm rather parochial. I only really look at precious, but the only other index I look at is the CRB index, and I can see that's performing very strongly. I couldn't identify you within that which components are driving it, but that suggests to me that yes, commodities are in a bull run.
I think it's rather mixed. Oil has tended to disappoint. Our oil analyst is explaining that even circumventing the Red Sea, it only puts $1 or $2 on the price of a barrel. The demand on that area seems to be sluggish, but the climate change always makes the ags problematic, to say the least. So I think it's mixed, but on balance, slightly bullish.
Yeah, I'm going to say also pretty mixed. In fact, I'd say neutral right now. I think some of the economic headwinds that we've identified are a part of that. I think if we look to some of the base metals, potentially markets that are going into oversupply, I think it's quite revealing, and this relates to palladium as well, how we're seeing a scale back on some of the commitments to electric vehicles. For example, the US administration, the Biden administration, have talked about delaying the adoption of electric vehicles. That's quite significant, of course, in an election year. That's potentially negative for things like nickel and copper and cobalt. It's relatively more positive for palladium in the sense that market share of ICEs may continue, although it does have its own structural headwinds in terms of a slowdown in vehicle production and sales in many markets. I think generally speaking, we still see the longer term trend towards electrification. That should be positive towards the base metal commodities, but it isn't happening as quickly or as big a magnitude away as we may have thought a few years ago. We've already seen some of those EV targets being scaled back in places like the UK, potentially also in the European Union. So there's very much some acknowledgement of some of the challenges that come alongside that aggressive positioning of a particular technology over others.
Okay, great. I
One thing
have
I
a
would
very
just
different
mention very
view on the
quickly.
short term. I think commodities are in a neutral to bear market. It's the capex, the inflows, the sentiment, the position. It's the comparisons to 1990s, and it's all about tech. I think it is noticeable, but I think in the medium to long term, absolutely, with commodities as a whole potentially being weaponized this year with policymaking, I think it has. It definitely has the potential to come back, and it's just we're in it's sort of hunkered down at the moment, and just sort of case in point, I can get a hotel at PDAC a couple 2 weeks before, which wouldn't be the case in a bull market, right? I have a couple questions from the audience. Question for you, Ross, regarding silver. What is your price forecast over the next few years, and do you see a potential squeeze?
On silver?
Yes.
Yeah, well, my forecast was pretty in line with everybody else's actually, at 24.88. Another record supply deficit, and we're seeing the cumulative effects of those shortages perhaps beginning to bear a little bit of fruit. We see the high at $28, not reaching $30. So mine supply is shifting lower, demand rising by about up 8% on the year. In other words, a positive but not outrageously so outlook for silver. But you know, I don't study the supply-demand fundamentals that much, and I don't think silver does either. I kind of look at gold and leverage off that, benchmark off that. Where's gold going to go? Silver's going to follow. It tends not to take the running. So if you want to know silver, no gold.
I totally agree with that. It sort of trades as an investment asset class to some degree. So on that point, I'll ask all three. Do you think, yes or no, do you think silver will hit $30 this year?
No.
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 Okay, well, consensus
I would
there.
add very quickly, though, that, you know, also on commodities and precious metals, look at the dollar. You know, if the dollar is going to be strong this year, which is our view, for a whole range of things that I don't have time to get into, that's going to be a suppressant on commodities, and it could also be a negative, particularly for gold and silver.
No, absolutely agreed. If Trump wins the election in November, is that a net bullish or net bearish development in the short term for gold?
Bearish.
Bearish.
John?
I think short term bullish, a relief rally, you might say, but longer term, I think it will steadily trade lower. But in the weeks, days after the election, potentially higher.
Stocks
We saw that last time, didn't we? Just after Trump won, we saw a significant fall in US mint coin sales. We saw a decline in ETFs. I mean, like it or not, gold is something of a right-wing asset, or is seen in many countries as being so.
Right.
Ask Germany, where it's been taken to the extreme. So I think that probably should Trump secure a second period at the White House, then I think that, as John says, you'll get a knee-jerk response like we did last time. But thereafter, I think you'll see a decline in the physical demand in ETFs, just like we did last time. It'll be quite significant. So I like to think of myself that puts the bull into bullion, Jim, and there's more than one way of reading that. But on this particular one, I'm a bear. Yeah,
and watch the polls going in, particularly from August, going through into the election. In 2016, they favored Hillary Clinton, and gold and silver did very well from a retail, especially coin and bar perspective. And then the coin and bar market died after that and didn't pick up again until it looked as if he was going to lose the presidency.
Yeah, I do think the one difference this time versus 2016 is it was very much a surprise and a shock last time, and it's already been priced into the equity rally this year. So it, you know, if he does win, it'll be much less of a surprise, and I think markets will, John, sort of along your thinking, will preempt that and position accordingly in the lead up to elections, according to the polling.
Right, absolutely. I think there's less of a surprise element here, but there is that knee-jerk reaction to the implications for global trade, what it means potentially geopolitically, and I think that might engender that short-term rally. But longer term, as Jim and Ross says, the underpinning of physical demand from retail investors is not necessarily going to be there, just as it wasn't there in Trump's first term. And you might also say that would be true of silver. We saw a huge volume of silver eagles being sold through the mint in the run-up to the election. It went away for a lot of Trump's first term. When Biden came back, it picked up again. So to that point, it being something of an asset for you know, a certain section of the population when they fear that the federal government is coming after them.
Right.
Just to put some other numbers on that, US coin sales, I have the figures here, were 140,000 in the period in the month leading up to the election in 2016, and it went down to 20,000 in January 2017, a fall of 85% on the physical coins.
Wow, very interesting. So just to wrap things up, I think one last question. We'll put it to gold. It's basically $100 off from all-time highs around about. Do we see all-time highs first in gold or 1900 first?
That's an easy one. 21.
We know your answer, Ross. Okay, all-time highs first.
Yes, I think all-time highs first, and as the year progresses and the dollar is likely, in our view, to stay firm and rates are not cut as quickly, then recalibration later. And then after the election, you know, who knows, but most elections will have been fought by the end of May.
John?
Yeah, all-time highs in the short term, driven by those same factors we've been talking about. But as that disconnect emerges between market expectations of rate cuts and the actuality of rate cuts, I think that gold is in for a fall.
Great. Well, thank you to all three of you. Thank you to the LBMA. And I'll turn it back to you, Tamsin. Thank you.
Thank you. Yeah, I just want to say a big thank you to all of our panelists today for their insights. Before we go, I just want to share some of the upcoming LBMA events and activities. So coming up in March, we have our Sustainability and Responsible Sourcing Summit and our LBMA annual party, and they are both taking place in London. In May, we've got our LBMA Open House, which is taking place during the London Platinum Week. In June, we have our Introduction to Responsible Sourcing and Introduction to Loco London training courses. July is our AGM. And in October, we will be in Florida, Miami for the Global Precious Metals Conference. We hope to see you at some of these events. You can find out more information on lbma.org.uk/events. And if you want to rewatch this video or any of our other videos, you can do so on our website, lbma.org.uk/videos. So again, thank you to our panels. Thank you for joining us today, and I hope you all have a lovely day. Thank you.
Thank you.